Oh, wait. Are we live? Oh, sorry about that, folks. Uh, Welcome to the show. This is a show about we're going to talk about the potential bear market coming up right now, and I just want to give you some thoughts on it. With the downturn in the market last week, we experienced a lot of people coming on and a lot of news reports saying that we're coming into a recession. The fact that interest rates went so low and the yield curve inverted means that there's a recession coming. And every time we get a downturn in the market, all these stories will come out. And to the casual observer of the stock market, like if you're just kind of out there in the public, and I know my friends here who are traders talk to normal people at times that aren't traders. People only hear about the down moves, right? So the market will sell off and then it will rally back. But people just remember, oh, wow, the market was down so much. And oh, my goodness, how can anybody ever make money in the stock market? So let's just talk for a second about where we stand. And before we do that, let's define terms here. Okay, so a recession, the sort of technical definition of a recession is, well, it varies from person to person, but the generally accepted one is 2 quarters of down markets in a row. So if you've got a half a year where the markets are down, then that could be considered a recession. If we look at the chart of I like to look at just the major indices, and I look at the E-minis, which represents the the S&Ps basically. And if we look at the chart, we can see that we're not too far off the highs, right? I mean, we haven't made a whole lot of progress, however, since if you look back here, this chart starts in 2018. So we were up around 29.34 in 2018. Then we had this big dip, went back up, another little dip, up, another little dip. So we really haven't covered that much ground since 2018. But this chart could be described by different people in different ways. Certainly, people like to say, well, we rallied X% from this low down here in December of 2018. So we've made, if you bought the market down here, you've done great. People could say, oh, the market really sold off then. It was terrible. But if you had just kept your stuff in the market and bought like the SPY way back here in this area, you would have made no money from 2018 to now. So it really depends where you entered and exit, whether the market to you has made progress. It also just sort of depends on which stocks that you were in. However, so when we look and see that like the market's the same place it was in 2018, that tends to make you think that like the market's not really doing much. But if we were just to change, once again, it goes down to like what time frame are you looking at? If we go to this time frame, from February till now, we can see a period of volatility here. Really, I mean March, then up, down, up, down. And if we look at the chart in this time frame, it kind of looks like it looks very bearish, like we're going lower from here. So the question is this rally over? They talk about having it being a rally for years and years. And the answer, which I've said before, is that you really can't tell where we are in the moment. You kind of have to wait for some time to pass to see where we are in things. So, back in, if we'd talked in December, when we were way down here, people would have been very negative because of this big down move. But this huge rally back here gives people optimism. So people get caught in a little snapshot of where they are at the moment. And my challenge to you is to kind of try to pull back a little bit from the current moment and try to look at things from sort of a wider perspective. I remember that was the advantage of taking acid back when I was in college days, was that it lets you take a view of a perch high up above things and have a better perspective. So the perspective that I see when I try to detach myself from stuff is that we are near the highs of the market right now, and we haven't had 2 quarters of down moves. In fact, we've had a pretty big rally this whole year. From it was a little bit lower in December, but we've had a pretty big rally this whole year. And the fact that we sold off a couple weeks ago doesn't diminish that. When you think of the world, and this might be getting a little bit too philosophical for you, but when you think of the world, every year more and more people are born, and we know that governments print more and more money, and so there is more and more money to invest every year, and it's got to go somewhere, right? Every week when people get paid, or if you get paid every 2 weeks or every month, tons and tons of people have automatic investment plans for their 401k, right? You probably have one yourself. Takes a little bit of money from your paycheck and invests it in the market, right? So that money is always coming into the market every week. Millions of people have this little drip money that they're investing in these funds. And it's mostly going into ETFs these days because that's the sort of vehicle of choice. And so for the market to go down, there has to be a force that's greater than that pushing the market down. And we talk about things like, well, this generation's retiring, or the baby boomers are retiring and they're taking their money out of the market. Or we talk about big hedge funds making moves. We talk about these big players sort of manipulating things from the top. But for the market to continue to go down, there has to be continued selling pressure, people continuing to want to get out of it. And this has to overcome that continuous drip of people's automatic investments going into the market. So in a sense, if the market is just sort of left to itself, it's going to rally because there's more and more people in the world, there's more and more money in the world, and there's only the same stocks out there. So that dynamic, to me, overwhelms everything else. Of course, you could have people that are fearful and take their money out of the stock market and don't believe in the stock market, and that can make things go lower. Things can certainly go lower. Sometimes people like to talk about how, well, it's all run by computers now, and they've taken emotion out of the market. It's very organized and regimented and whatnot. But the reality is, the real people don't give computers their money and just forget about it. In the end, things are based on human emotion. Even though we use computers as an interface for that emotion, still things are based on emotion. So we can certainly have a huge sell-off. We can certainly have a crash. However, left to itself, the market continues to rally. And it's going to do that whether, it's not like the people. Let me ask you, if you are putting money in your 401k, are you going to stop doing that because are you going to say, I'm not going to invest money anymore, I'm not going to save anymore for my retirement because the market's been rallying for 9 years, so I'm not going to invest anymore in my retirement. I'm going to stop saving money. No, most people aren't going to do that. Me personally, I do that. Like a lot of my long-term savings is out of the market, and just in cash. But I mean, the average person they're going to have a 401k, and they're going to have it invested in whatever their company automatically invests it in, right? Which is usually a blended fund where it's partial bonds, partial stocks, depending on how old you are and when you plan on retiring. Whatever the default contribution is, they're going to have their money in that, and it's just going to keep going in over time, over time, over time. And, the kind of person that's watching this program may be a bit more sophisticated than that, but we want to look at the average person when we're thinking about these things, because that's going to be the overwhelming majority of the effects on the market. Now, there's been much said about how the market doesn't represent the average person. It represents a few rich people that have most of the money are controlling things. And there certainly is that dynamic out there. And it's hard to get a sense of what those people are doing and feeling. But I believe that a lot of wealthy people, they just leave their money. Most of it just is left where it is in the market. So they're long the market. And I just base this on a lot of it on just talking to people that I know that have money in the market. They leave their money there, and it's just left there. It's left there for generations, really. And so the vast majority of wealth that's contained in the markets is just sitting there. It's only the small percent that's trading back and forth that's moving the actual markets. And so unless like the actual like fabric of society is like put into question, there's only a small percent of the money that's actually trading back and forth. And there's this dynamic of every week, every amount of time, people continuing to need a place for their money to go to, their paychecks to go to, their savings to go to. And so there's this drip, drip, drip of money coming into the market all the time. And yeah, you can get people that are fearful for a little while. They take their money out. But once you've taken your money out and the market goes down a little bit, people, they tend to put it back in because their money needs to go somewhere. We found that U.S. bonds have gone down a lot because people are attracted to the U.S. It's stable and it represents something that they can trust, and thus, and plus, U.S. bond yields are not negative right now. So even like a 1.5% is better than, is collecting some sort of interest for your money. So, and with one of the effects that's confusing about interest rates being lower, it sounds on the surface of it that interest rates being lower is a good thing, right? You can get cheaper loans. You can buy a house and you don't have to pay as much interest. And we talk about why do they lower rates? Well, they lower rates to stimulate investment. You can borrow money cheaply. Well, that all sounds pretty good to me. It also sounds like, well, given a choice now of buying bonds, let's just put it in extreme terms. If bonds pay 20% interest, then and you have a choice between bonds and the stock market, I would go to bonds because you get that 20% automatically. The stock market goes up, what do they say, an average of like 10% per year over a long period of time. That's been historically. Well, if you can get 20% interest on bonds, you'd choose bonds, right? As bonds, well, what about 10% interest on bonds? Well, then it becomes a little bit more questionable. I would probably still do bonds because it's that guaranteed 10% versus maybe 10% in the stock market. Well, what happens when bonds go to 1% interest? Well, it's almost worthless to me. Why, yes, that's nice, that 1%, but I don't have all that much money, and I'd almost rather just keep cash ready to invest in something than put it for 1%. So the lower interest rates get, the more attractive the stock market becomes. So, and that's one of the reasons why the administration pressed to lower interest rates, because they know it makes the stock market more attractive and holds asset prices up higher. And, all of this interest rate cut stuff, yeah, it's, when you talk to the economists and stuff, everybody's afraid, oh, wow, it hasn't been this low in a while, but it doesn't sound that bad for asset prices and for companies who can borrow money for almost free and actually sometimes get paid to borrow money. So I don't see all the all these negative signs that economists are talking about it seems like the market can easily continue to rally from here, from my point of view. I'd be interested in your point of view, and so please leave that in the comments. I am going to be doing a basic video on UVXY, what it is, TVIX, what it is. It's funny, this TVIX video I made like years ago gets all these views, and I kind of would like to sort of redo that and just go basically over what UVXY is. If I do it in a nutshell right now, UVXY is a vehicle to trade on people's fear about the stock market. When people get fearful, they're willing to pay money to try to protect themselves, and they're willing to pay more money than that protection is actually quote-unquote worth. And so, in essence, when people get really afraid, all of a sudden this bell goes off, and people like me say, oh, you're afraid? Okay, well, I'll sell you some protection. And we sell this product that's kind of a crappy product, which is UVXY, that people buy it thinking it's going to go up if the market crashes, and it will go up, but it only goes up temporarily, and it's slowly moving lower all the time due to a number of other things. So, people like me have identified that UVXY is a really crappy product, and thus, to be short something that's crappy is good because it just keeps going down. So once identifying that UVXY is always going to go down, we find the most efficient and sensible way to capitalize on the fact that UVXY always goes down. And when we get a big pop where UVXY goes way up, that's the best time ever to be selling it because we know that it's going to go back down to the lows and break below those lows sometime soon. So this is an exciting period for people who like to short volatility because we did get a big pop. UVXY got above 40 actually after taking out the lows in the 20s, and so it's an opportunity to sell this crappy product that's just going to go back down again. The more fearful people get of a recession and whatnot, the more UVXY goes up, and if we can just weather the storm of it going up, we know it's going to go back down again. So that's the basis behind UVXY. All right, so let's take a quick look here in, let's see, do I have the dashboard up? I'm not even sure if I have my dashboard up. Let's try to pull it up here real quick. So that's the basic scoop of UVXY, but I want to go over the reasons why it's such a crappy product and give you a more compelling argument on that in the next video. Look, have a great weekend. For me, the more articles that come out that saying we're going into a recession, the market's going lower, don't put your money in, take it out, that is a bullish contrarian indicator to me, and it's when people aren't looking to the downside and aren't afraid that you have to be fearful in my understanding of things. So the more talks of recession, this and that. I was watching a political YouTube channel that basically just covers politics and policy and that sort of thing, and was talking about, okay, we're definitely going into recession. That's what everyone was talking about last week. And they're just kind of reporting on what people are reporting on without going into the fact that we're not very far off the all-time highs in the market, and we've popped back from, that down move that we had was like a week ago, and we haven't broken any lower since then. In fact, we've popped back. Let's just go to the chart one more time to remind you that before I go off the air here. Look, here's where we are in the chart. If we get back down to this 2316 area, then that's a different story. But right now, we have we sold off a little bit. We popped back a little bit. We sold off a little bit again, but we haven't even breached this 2775 low yet. Now, that might happen. Sure, it might happen. But in the meantime, I think that these recession fears are unfounded. All right. Thanks for watching, folks, and enjoy the rest of your weekend.